In today's video, I would like to talk about the cost of carry. A lot of traders have asked me that how do I roll over the positions and what is my strategy regarding rolling over a future position, and also what how should they go about trading the futures market with the 2 lakh, 5 lakh, 10 lakh, 15 lakh trading capital. So I thought that I will address some of those queries, and let's begin. Currently what I have done is I have just added three contracts here. You can see this is Nifty August, Nifty September, and Nifty October. In Nifty August, we can see that it is priced at 24,550. Nifty September is 135 points higher, which is 685. And Nifty October is at 24,800, which is roughly 250 points higher than the August future. In turn, the August future itself is at a premium to the market. So we can see that this is the index closing here. We'll just say approximately 500, it's 485. So the August future in turn is at a roughly 63 point premium to the market. Now, how does this impact us as traders, and why is this premium important? So let's just come to this screen. We'll remember these values here. Currently, you can see that the commodities is the commodity market is currently active. So you can see gold price changing. So let's just come to the screen here and let us understand a very simple concept, that is that at the time, so basically, yeah, I'll just select the correct font. All right. So any derivative contract has an intrinsic value, basically is made up of an intrinsic value, and let's just call it an extrinsic value. So intrinsic value basically means the actual value of the contract. For example, we can see that Nifty closing is at 24,487. So any future of Nifty, if it is trading at 24,487, then it is trading exactly equal to the spot or the underlying. And therefore, at that point, we can safely say that the intrinsic value is 0. And therefore, the contract value is equal to the intrinsic value. The extrinsic value is 0. I'm sorry. Now, when we come here, we can see that the contract of the August future is priced at 24,550, and we know that the underlying has closed at 24,487. So obviously, we would know that if we add 63 to this, we will get the value of August future, which would mean that the intrinsic value is 24,487, whereas the extrinsic value is 63. You can see the working here. So this is the spot price. This is the underlying price, which we call as the spot price, is equal to 24,550, which is this is the August expiry. We are talking about the August expiry. And this is the intrinsic value of the market, 24,487. And therefore the extrinsic value is 63. I think this is reasonable. Similarly, if we look at the September expiry, we will see that the September expiry was priced at 24,685. So here we know that this expiry is priced at 685. We also know that the spot value is at 487. I'll just call it at 24,485, which means that there is a 198 point extrinsic value. There is a 198 point extrinsic value. Now, and we'll just repeat this exercise for October, and you will see that the October is priced at 24,850. We know that the spot is priced at, I'll just check if it is 850. I think it's 800, sorry. It is priced at 24,800. The spot is priced at 24,487. And obviously the difference, which is roughly 313 points, will be the extrinsic value in this case. Now, what is this extrinsic value? So we understand that a single lot of Nifty obviously has 75 quantity into it. And let's just assume that the market is priced at 25,000. So a single contract is equal to roughly 18,75,000 rupees. But when you are actually trading the market, at that point in time, the exchange doesn't require you to have 18,75,000 rupees in your account in order to buy that contract of Nifty. What they ask you is for a margin amount. That margin amount is typically 1/5 or 1/6. So they could ask for an amount of, let's say, 2 lakh, 2 lakh 50,000, 3 lakh rupees, depending on the volatility of the market. Which means that in order to pick up a contract of 18 lakh, we only had to give a margin, let's just say 2 lakh 50,000. So logically, it means that everything else is on leverage, which means let's just call it a loan. That is, we have taken the remaining 15, 16, 17 lakh rupees, the difference of the contract value has been taken on a loan from the market. And that loan is obviously not coming for free. It is coming with a premium. And which means that whenever you borrow money from someone, that person is going to charge you some interest. And in the market, this interest equivalent is called as a premium. And how much interest they're going to charge you is a function of how long you want to take that loan for. So anyone who's trading the August series, since at this point in time, we are at almost the midpoint of August, he or she is borrowing for just 2 weeks. And therefore, that person pays a 63-point premium. Whereas the person who's taking for the September expiry is taking it for 6 weeks, almost three times the duration, and therefore we can see that the cost is also almost 3 times higher. That's the premium. And such is the case also with October. Now that the person is there for 10 weeks, which is 5 times. So we will see that the cost is also 5 times the initial one. In other words, because of the leverage nature or the loan that we are taking from the market, we are going to be paying a certain amount of money as premium. And this premium is a function of the ongoing interest rates, and it is also a function of how much time is left to the expiry. Now, at the time of expiry, what happens? On the day of expiry, as per theory, the derivative contract price is equal to the intrinsic value only. Which means that the extrinsic value actually becomes 0 here. Why? Because on the day of expiry, you are not really taking any loan now. Now the loan is going to get cleared. The loan that you took for say 15 days, 3 months, 2 months is factored in this extra price that we pay in order to buy that contract. This is the loan that we get in order to buy that contract. Now, since on the day of expiry for that instrument, there is no time, therefore there is this extrinsic value becomes 0. In other words, that the derivative contract equals to the intrinsic value, which is nothing but the spot value or the underlying, the value of the underlying, right? Which means that let's assume we buy Nifty exactly here at 24,485.4, the closing price at spot. We would have to buy either the August contract, the September contract, or the October contract. These are the 3 options that we actually have in order to buy. Given that we would pick up one of these contracts, we would be paying a certain amount of premium, 60 points, 200 points, or nearly 300 points. We would be paying a certain amount of money as premium to the market. Now, if the market on the day of expiry closes exactly here at 24,487.4, in that case, you will obviously get the full intrinsic value, but you will lose out on the extrinsic value, which means that if the market closes at the exact same value for the August contract, you will lose 63 into 75, right? Which is some value 4725. For the September contract, we would lose 198 into 75. All right, and for the October contract, we would lose 313 into 75, right? What this basically means is that if you buy and the market does not move anywhere, I mean it goes up, goes down, but on the day of expiry it is closing exactly here, this is the money that you are certainly going to lose. All right, please note that we need a margin of 2,50,000 rupees to pick up one lot of Nifty. And if you end up picking any one of these lots, this is the amount that you are certain to lose the minute you take up that trade. I hope this part of it is clear. Now, what happens if the market rallies up? If the market you bought and the market rallies up, then the index needs to rise a minimum of 63 points in the month of August for you to make a profit. It needs to rise by at least 200 points in the month of September for you to break even. And similarly, 300 plus points till October in order for you to close in profit. So which means that the minute you buy, you have already given away anywhere between 60 points to 350 points to the market the minute you take up that trade. And the impact, and actually it could even be higher. Sometimes the market trades at a discount. There are various factors to it, but let's just use this as a reference because this is the standard default. You will always get a premium ranging between 10 points to 150 points on Nifty for the current expiry. 60 is pretty much in between. So so coming to the point, the minute you take the trade at, let's just say for 3 months, you are risking almost 25,000 rupees, and given that you need 2,50,000 rupees in order to take up this trade, just the premium alone is 10% of your account value. Now if the market rallies up, the market needs to rally by minimum of 60, 200 and 300 points for you to break even for the corresponding. But if the market loses value, that is if the market comes down, you will lose the difference, which means let's just say market closes somewhere at around, I'm just giving a random number, say 24,000. You would obviously lose the 485 points on the intrinsic value, plus you would lose the extrinsic value. Which means that we know that the market has a tendency to range. For example, if you look at this phase here, the market has ranged for a very, very long period of time. And essentially the market is exactly where it was almost a year ago. Pretty much last year August, the market was right around this level. This is last year August. So in a year the market has moved absolutely nowhere, and for the greater part of the year the market has traded below. So in other words, the market is in a phase where it is not giving us very good, it's not a very strong trending market on this particular time frame. So the minute you take up a trade, you are certain to lose the extrinsic value, and if the trade goes up against you, then at that point in time you also lose the intrinsic value. And this is where this is what you need to understand, that you, on an average, you are risking 5,000 rupees a month. That's the bare minimum if you trade only one lot on the index. That's the average you're risking, which means that you are risking 60,000 rupees a year. If you maintain strict discipline, just take up one lot, hold it till expiry, keep your account well funded. So 60,000 rupees a year on an account of almost 2.5-3 lakh rupees is the amount that is minimum at risk. And then you have all the aspects of money management, stop losses. If you want to take partial targets, you will need more than one lot. You need 2 lots, maybe more. And that's where all these concepts come. Now, what is my point? My point is that when the index margin requirement is 18 lakh, the contract value is almost 18-20 lakh. An account of 2.5 lakh doesn't cut it. Now, if you are going to spend an average of 50,000 rupees to 1 lakh rupee a year just on premium, you tell me how much should the account value be? We all know that premiums, if they are over 1% of the account value, it is extremely expensive. You can try it out. You can check out your health insurances. You can check out any insurance you want. There is a risk underlined, and then a small percentage, a basis point percentage of it is chosen as the premium. So if you are going to risk 50,000 rupees, I believe a year just on premium, then your 50,000 rupees should be less than 1% of your account value. And this I'm talking about even without knowing what your money management rules are, what your stop losses are, what your targets are. I'm not even getting into those concepts. I'm just simply talking about the sheer price that we pay as traders in order to simply keep a position open in the market. And this is just the premium. Then there is, of course, the additional parts of increased STT and so on and so forth. A minimal brokerage that is charged, which basically has made trading an extremely expensive profession. In other words, the minimum cost associated of doing the business in the futures market, in the NSE-FO segment, if you're really looking at it, the cost of doing business is somewhere between 1 to 1.5 lakh rupees a year. This is how much it is going to cost you. Just the trading activity is going to cost you that much. And this is me assuming that we are trading with a certain rule. That is, we are not just, I feel like taking up a trade position, so I'm buying 10 lots or something. Not like that. We are trading with a certain structure, which means there will be phases in the market where our trades are not getting created. Then there are phases in the market where maybe we are booking losses, and equal phases in the market where we are also making money. So when we go through these cycles of profit, losses and inactivity, in general, I think that it is reasonable to expect that a cost of 1 to 1.5 lakh rupee is almost a given. It is certain. and therefore the account value should be at least 50 to 100 times of that value in order for you to take up the trade. Now, you would say that you obviously don't have 50 lakh rupees, you obviously don't have 1 crore rupees. So, what advice would I give you? The advice that I would give is please trade commodities. Okay, I mean, if you look at, like, for example, if you look at gold mini for here, I mean, I think there is a gold M contract here. You can see that this is the cost of 10 grams of gold, right? If I try to buy it, I means you will see that the margin required here is just 72,000 rupees, right? It is just 72,000 rupees. I means the contract value will be approximately 9 lakh and the margin required is 72,000. Here we are getting far greater leverage and the cost associated with trading are far lesser, and the reason is because the commodities markets wants to promote commodity trading, which was the case with the stock market in the 2000s, 2010s, 15s, I think right up till COVID. They wanted to promote trading, and therefore the costing was such that it was cheaper to trade future than it was to trade equity. Now the costing is such that it is going to cost you 5-10,000 rupees simply to hold on to a future lot, which means that if you are taking small targets or if you're booking small losses, you are simply going to pay more in premium. In other words, you must now, I mean, if you're going to pay 5,000 rupees to have an understanding, 5,000 rupees on a Nifty is roughly 80 to 100 points of just or at least 60 to 100 points of market movement. So 100 points is simply the premium. So if 100 points is the premium, you should try and come up with a trade in which the stop loss is maybe 450, 500 points now, or even more if possible, if it's justified. And if your stop losses are going to be such wide, then your targets also have to be wider. And if your targets have to be wider, then obviously they by definition cannot be a short-term trade or a day trade. In other words, the prohibitive pricing that is currently ongoing in the market through premiums, through STT, and the margin that is required, the exchanges have created the structure such that you are heavily penalized for taking up short-term day trade positions. You literally have to overcome a lot of costs in order to do it. Now, extremely short-term traders, their argument is that if there is a 63 point extrinsic value on the same day, there is not a full 63 point erosion of the extrinsic value. There could be a 3 point, a 5 point erosion, but it will not be like the entire 63 points are gone. Or if you're trading October series, it's not like the entire 300 points are gone. Maybe you have 2 points are gone. And it is true, but you must understand that even if 2 points are gone, or 3 points are gone, or 5 points are gone, you're doing this every day because you are by definition an extremely short-term trader. So over a period of time, you are going to catch up the difference any which ways. So with this video, what I wanted to get across was that it is very expensive to trade derivatives. The lot sizes are too big, and a trader who's starting off their career should really look at the commodities market in order to practice their technical analytical skills, money management skills, because you simply cannot manage money here. I mean, if you're going to be paying 1 lakh rupee a year simply to participate in the market, and your account is only of 5 lakh rupees, so where is the role of money management here? You need the first few trades to work in your favor, otherwise the account is immediately going to go bust. And that anxiety that the initial trades must work under any circumstances, that anxiety is going to foster a series of poor trades from you in the future. So we should not set ourselves up for failure, and the intention is to know what we are doing. I'm posting a video after quite some time, and this is largely because I had like some issue with the back, and I had to go through quite a little bit of physio. I had as you can see, I have like this posture problem. I don't stand straight, and with the weight and everything, this has compounded over the years, and consequently it caused some muscle spasm. And I had to go through an MRI, a physio, and quite a long, lengthy bed rest process. And consequently, the students who are in upsurge group, I have not been able to reply to the messages. And also what happened is that, 5 messages became 50 messages, 50 messages have now become 500 messages, and now I all of a sudden, like, when I see I have almost 500 to 1000 messages to kind of reply. And I just get so overwhelmed when I look at that I have not been able to reply to doubts, and I have not been able to reply to the Guru Purnima greetings that I got from some very kind students, and I really appreciate that. It's just that I had been a little under the weather, so to speak, and I had been busy with other things consequently, because all the focus then shifted on just getting the health right. I was also to come to Mumbai to meet the team at Upsurge, and maybe we were planning on hosting a student get together. Um, but that just happened pretty much at the time the injury coincided with my travel time, and it set me back, and therefore there has been a delay. It's not to say that I'll be like posting every day or something. I just I'll be sharing a few things as and when I feel like, and I'll keep you all. And we'll also discuss some technical elements to trading. And if you all have any queries, I have also not been able to reply to the YouTube comments that are there. So I will. YouTube comments are far smaller in number, so I will reply to them. But in the meanwhile, of course, like if you have any suggestions on a particular concept that you would like to cover, or topics that you would like to cover, feel free to just leave it in the comment section, and I will see what I can do with it. I hope you all have a good week of trading ahead. I wish you all the best. Thank you for your time.